Hey everyone, this is the 7th of April 2016. We've just concluded the week with the RBI policy, and coming right a month after the budget, it was the next most look forward to event. And depending on which part of the investment world you're in, you'd probably look at this event as positive or negative. But you really have to put it in perspective of the macro picture, and I think that's something that most people don't do, probably because it's what I should say, occupational compulsion for many of them to look at it in a very different way. For some, it's always to look at only the bright side of things, but uh, uh, you know, I'm not saying that there was nothing positive in it. I mean, you cut rates, you're improving liquidity, but you need to put it in the macro picture in terms of where you are on the overall economy, the debt cycle, the broad-based growth that you're really looking for, and that's when you start finding misses. And so beyond that, when you start putting it in global perspective, then it's a completely different case altogether. So there are so many other factors that you need to keep in mind. Then just look at one, and somewhere I think we've stopped reflecting on the big picture. Actually, when I go back to and look at 99 2000, that's when the tech bubble took off, and I would be just looking at my own chart and saying, yeah, well, this is going up or this is going down or it's overbought. And then there would be days where the market would really shoot up, and more than the index, it would be all the tech stocks hitting the upper circuit limit. And then I would be told in the dealing room that, well, it's the Nasdaq. That's what moved up last night. And I would say, why the heck do I need to look at the Nasdaq? And when I can look at my own chart, why should I have to look at what happened overnight in the Dow and Nasdaq to tell me how the market's going to do today? And even if it's an overnight indicator, it cannot be, it can probably give you a broad indication of where things are headed if you're looking at a chart, for several days. But a day-to-day movement should not be a forecasting tool. I mean, just because something happened last night, would the trend be the same here? Now, that's increasingly not the case. However, the importance of global factors has definitely increased. So even between the 2001 2008 bull run, I probably avoid mostly looking at what was happening in the night in terms of what's in various markets. Even now, many times I do avoid looking at it, and then I just wake up in the morning and get to know, okay, what's going on. I don't like someone calling me and telling me this is what it's doing. But definitely, if you're trading, the commodity space, you need to be watchful of if you have positions there based on certain levels. But you can have alerts there and actually be indicated of what's going on. But my whole point is that when you're taking a view, you're essentially looking for end of day charts, which is why I write my everyday IC mornings based on what the end of day charts of all the markets look like, and so that's my morning task. To scan each and every daily chart and see which indicators when to sell or buy, or which wave counts completed, and put out a post on them. So that makes up my daily process, and it's increasingly become an important part of what I do, at least in the last couple of years, because of the role the global markets have really played in a bigger and bigger way. So I think 99 2000 was just the beginning of the integration in terms of Indian market with the world markets. And when you had a bull market going on, you really, and you had all the domestic flows, you really didn't need to look at what was happening to world markets on a day-to-day basis to even understand what was on, because you had your own bull run going on its own feet. But now the interplay of currencies, their impact on various asset classes, and their reflection of whether money is moving in out of equities into which countries has become increasingly important. And also, we're trying to get a sense of how this whole thing plays out, what all the central banks are up to, because for a while you'd want to get the answer, is it inflation first or deflation first? And I think the end result has been a real mix of it all, so if you said that you're getting inflation first, well, you can argue that asset prices are inflated, and then at the same time you can say you've got price deflation in terms of many inflation readings turning even negative and bond yields going down to zero and to negative rates. So you have these completely mixed signals, and the same parameters that pointed in one direction earlier on in the cycle, which means if you just go back to what the dollar did after 99 2000, when it topped and started to fall for many years, you saw the big run up in emerging markets and various in the US market and all the commodities. You had this big commodity bull run, and so it was all related to the dollar. And when the crisis started, and that was interesting that in the second half of the crisis, you actually got a strong dollar. And after that, everyone started associating the strong dollar with deflation. And that's something that, Robert Prechter pointed out in his book way back in 2002, that, a strong dollar is what would reflect deflation, because there would be a contraction of money. But as the strong dollar case has played out over time, it has started to mean something completely else. On the one hand, you did have a dollar rally with falling commodity prices, which reflects in some kind of price deflation. But on the other side, the dollar rally has actually become associated with a rising US market. One of the arguments is that all the money has moved out of other parts of the world and moved into US assets, and which is why the dollar is going up. After all, in floating rate currencies, the currencies just reflect where money is going. It's moving out of one asset and into another asset. So it's no more like the fixed rate world where governments would have to actually come out and announce currency devaluations. In today's world, the currencies just move. Sometimes there may be announcement in terms of broad direction, but there's no fixed date announcement of a devaluation, except maybe in the case of a yuan, you saw some of that because they were still not on a completely floating rate. But in the modern world, if you want to devalue a currency, you might not even get a statement. The government might still be defending its currency while it's actually being devalued. So you can be completely confused about what's going on. And so in that sense, we had this entire round of currency wars, which was played out not all at once in the form of a war, but actually through devaluations, one nation after the other, starting with the euro, then with the yen, and then that caused a runaway decline in all the other currency pairs, which was not really directly related to what happened in the euro and yen, but actually because commodity prices collapsed in various countries that produce commodities, from Australia to Canada to Russia, Brazil, all got hit, mostly the BRICS, and just leaving out the I there, and that caused its own trouble in all of those currencies. And which is why the USD-INR, while it adjusted with those declines, did not really fall off the cliff like it did in the earlier period. But what's interesting here, when you study this entire period, there's one particular part that I noted. I've written about it, and let me just repeat it, that when the 2008 bear market in the US started, the dollar continued to fall for the first couple of months, and then it stayed down there for some time. And in that time period, commodity prices were actually going up, which means you had gold prices shoot up to a new high by March of 2008. And then later, till June, you had crude prices continue to shoot up to an all-time record. So this was happening even as you were already in a bear market associated with the housing bubble. So it's only after that that the dollar started to rise and everything fell off. And when everything was falling off, even during a rising dollar environment, you had gold spiking up every time US equities were down as a safe haven trade. So in a sense, gold actually outperformed the 2008 bear market, even though it was falling. So those were some interesting trends. And so when you look at what has happened just in the last quarter, and that's why gold is so interesting. I've written about gold forming an ending diagonal, and I marked it right onto the day where it hit 1248 and made that low, and turned around on day one of that. It had just touched the lower end of the wedge, and a wedge essentially occurs at the end of a trend. So that bear market ended in gold, and it's probably started another bull run, or at least some significant advance from here, and that's why it's the most interesting asset to watch. And what has started to happen with that is that the dollar has started to fall. So you have this big change in trend from what was a rising dollar index on the back of weakness in the euro and the yen and the pound. You now have strength coming back to the euro and yen, and essentially while this is happening, and you're hearing the Fed come out with statements which are being called the most dovish, even though they're still saying, well, we are going to raise rates just slowly, and that actually means that rates are going to go higher, not lower, but it's been considered dovish just because it's a slow raise of interest rates. But if you've seen data coming out of the US, it's also pointing towards higher inflation going forward. So it remains a tricky mix in terms of, are you really looking at interest rates going down? Probably not. And if inflation spikes up by any chance, then you would get a surprise hike. So that's something that's not being considered by markets, because they're only going by statements rather than real numbers. But one of the real numbers that is getting accepted by the markets more is that all these currency devaluations did not lead to growth, or even the little bit of growth that came, it's just fallen off the cliff quickly. Worse off has been earnings, which have slowly flattened to turn negative across various markets, and even the markets have held up on liquidity. Earnings have continued to decline, and that includes India, it includes US, and it includes Europe. And so that is why the currency wars are being let go, because it's hurt the emerging world and it's caused no growth. Euros has let go of its currency. You're seeing it strengthen. The yen is strengthening, and if the dollar index actually falls below 94, which it's almost done today, then it clearly marks that you're not going to make one more attempt towards that 100 mark, that it's done twice, and the big decline in the dollar has already started, which means you have a major trend reversal from the rising dollar environment, which started in 2008, to a falling dollar environment. And that is being accompanied by rising gold prices and falling equity prices. So you have a complete change in terms of the relationships that you have been used to. If you looked at 2003, falling dollar meant rising everything. That's no more the case. It's going to be, the falling dollar is going to be bad for Europe and Japan, because both their currencies start to strengthen. They lose the advantage that they were trying to get from all those currency plays, and they've not been able to stimulate doing that. And now because all the money is actually moved into the US, the falling dollar essentially reflects what it did in the early part of 2008 when that bear market started, that is falling US equity prices. And that's what you saw in the first month of Jan itself. In fact, you should be surprised that you saw a falling dollar and falling commodity prices at the same time, except for gold. So that was the surprise element. And as US equities are starting to fall today itself, you're seeing the same pattern: falling dollar and rising gold, but still falling commodity prices. Copper is down, crude is down, and various other base metals are down. And if that trend continues, like I said, it will become a trend. So this is this complete change in pattern, and which is why it will surprise a lot of people who are probably looking for the same old relationships that they've gotten used to looking. So that's the big picture from the world scenario, something which, like I said, if India was in a bull market, I'd probably not be watching, but now I'm watching it closely because there are opportunities in the currency market better than equities. There's currency in gold, opportunity in gold, and which is why I've been reading out this new book. Not really to get a view. The ending diagonal has already given me the view that it's headed higher. But what's interesting about Rickard's books is that he goes through a lot of history. So if you really want to learn about economic history, his book, like on currency wars, covered everything that happened between Germany, France, World War I, World War II, what was done, what failed, what worked, and why they did it. And so a good economic history, well researched and put into one place, is what I found there. So I'm hoping to probably find similar knowledge about history that has to do with gold. But essentially, like I said, the chart's already giving you direction in terms of what these asset classes are likely to do. And currency plays have completely turned on their head versus what they were doing in the last 2 years. But I expect one major divergence, and that is that I do not expect emerging market currencies to necessarily continue to appreciate even as the dollar is falling. So you see the dollar index itself reflects the key currencies, euro, yen, pound, and so on. Of course, it has a couple of others like the krona and franc and so, but the weightages are significant for the euro, yen, and it's not necessary that that means that emerging market currencies would also see the dollar falling, that is, they would appreciate. Most of them have been declining for reasons, like I said, related to a weakness in their own economies, and because they've expanded their external borrowings or their corporate debt so much, so has India. Even though India's levels may be less than the others, we still have a significant 25% of GDP on external debt, and so currency issues are going to remain with many of these places in a slowing economy, because money will try to move out of many of these places, and that would continue to drive their currencies down. So the dollar index might not anymore be reflective of what is happening in emerging market currencies, which will only reflect what is happening more in their individual equity and bond markets. But what the falling dollar will mean is a stronger euro and a stronger yen, which would continue to weaken those markets in particular. Now you can argue that, well, at some point of time, Mario Draghi is going to come and do whatever it takes, and probably the same with Japan. But as we've seen, none of that has worked, and you'd wonder whether, just like when the first bailout program was announced, $700 billion bailout program because of Lehman, all you got is a 61% retracement of that most recent decline at that time in August to September, and then the market simply crashed from there all through October 2008 to significantly newer lows. So when you're in a bear market, the market itself is doing something very different, and it does not respond to those measures, and which is why there's this old saying that markets fall on their own weight. So that's the entire scenario of what's happening around various asset markets. Right, so in the first half, I've covered most of the global factors that also have a direct impact on our own market, since we have a good exposure to global equity flows, and that essentially means liquidity. And while liquidity plays an important role, at some point of time, you start getting the importance of macro, and that's what we've been seeing more recently. And so there's a lot of debate and discussion there. I think people are still not coming to terms of even calling what's going on a bear market, even though we've fallen more than 20%. You can have various definitions for this, but essentially, as most stocks don't participate. You have more than 80% stocks below the 200 DMA. I don't know what else you'd call it. But if you study the macro factors, and that's why I wrote the Economic Chondrotite Cycle 2.0, highlighting that things are playing out as expected. It took a long phase for the entire debt cycle to reach this point, simply because even though I wrote in 2009 that we were heading into a debt issue, and a lot of the companies with debt started falling right then, what happened is that, one, of course, you had a lot of liquidity coming in from inflation, OMOs, and so on, that got reallocated to sectors that were still growing, and the stocks that were high in debt continued to fall, borrow more, maybe borrow from abroad, and survive that phase, even though their stocks continued to decline, as the markets, as always, are ahead of the curve. So that part of the segment continued to suffer, even though they continued to expand on debts, and now finally you've reached the point where you've given whatever valuation you can to the inflation, long inflation sectors, and now that you've done that, you're actually seeing a slowdown in earnings growth come in, because, well, inflation plays in two ways. One is the top line, and then one is the cost side, and the cost side is basically catching up, and then of course you have debt, so that means interest costs going up are also becoming a significant portion of cutting into earnings. So essentially you need another round of inflation. So that's what I've been saying, I think, almost for more than a year since the Modi election, that there was so much hype around it. If you actually looked at a copy of any leading newspaper, especially if you say the Economic Times, and you'd see headline after headline as you ran into that election in terms of what economic changes the country was going to face. It was like going to be something mega. You just look at the newspapers a day after the election, and it was completely changed. Everything disappeared. It was like magic. So essentially what the markets tend to do is they over expect. They expect that you do something outrageous, But essentially the vote has been against inflation, and unfortunately inflation is essentially what markets like, in whatever form it may come. So from there on, slowly and steadily, we've seen the unwind first in most of the speculative grade stocks. They fell even against the market. Then once the market peaked, we've seen it decline step by step, but much slowly, because it's remained uh, you know excited because of the bubbly environment that got created at that point of time, which spread down to the roots, and the public came in investing into mutual funds, and a lot of that money drove into mid caps. The relative strength of mid caps reaching the higher end of its 10 to 12 year range, which is where it still is. It's just come off a bit from there, but in the early stages of what could be a further decline. But basically, we've seen that huge relative strength in favor of mid caps because of all the money flow. And now, as you'd come to the end of the money flow part, essentially what we don't have for over a year now is earnings growth, and that's again a global problem. You don't have earnings growth in the US, which is, you don't have earnings growth in Europe, and now you don't have earnings growth in India. Essentially then you're looking for more inflation. So that's what you were looking for initially from the budget, that the government would spend more. And the only reason to be happy that they're not spending was that, fine, if the government's not spending, the RBI is going to do the magic trick. And now we have had the RBI policy this week, and while we do have some tricks, wouldn't call it a full magic trick. You don't have a scene where you have a major cuts or a significant move towards rate cuts. You do have a lot of liquidity influx, and you have to look at it in the overall picture. I mean, one side you can look at and say, oh well, this is all liquidity going to drive up the market once again and inflate it. But essentially, I think what we've been doing for the last 1 to 2 years is try to walk the middle path. I mean, on the one side, you do have a debt problem. You have corporates which have borrowed a lot. They're getting into trouble. The government does not want to crash that segment. At the same time, we want to resolve it. And the RBI having pushed banks to start writing off those losses, you don't want the impact to come across the economy, and to the extent that whenever you go through this credit contraction phase, which is essentially, the right word is deflation. So as I say, India is in an economic winter. We are going through our own deflation. We want to do it slowly and steadily without having too much economic impact, which is good, which you can do, provided that you do not get any external shocks, and which is where the risk continues to lie. So in that sense, what they're doing is they're on the one side dealing with the debt problem, and on the other side, the RBI is going to provide the amount of liquidity that the banking sector needs and is going to need through that contractionary phase to balance its act. So it's more a balancing act rather than an expansionary act. So essentially, neither the budget nor the RBI policy is expansionary, and in that sense, not something that would very clearly drive earnings growth. It may drive GDP growth and have growth going into some segments of the economy, which is what has happened for most of the last couple of years. But it's hard to see whether you'll get an across the board earnings expansion, at least not across the board. So it would again be stock specific, and that leaves us open to risks and shocks from the external side, which I've already discussed in great detail. So that's the picture, and given that, I think we would continue to see a lot of volatility in the market. You can get 1,000 points up, you can get 1,000 points down, and that's what you're going to have to keep dealing with, which means timing the market. And we're also starting to see some of the sectors which are the best performers or outperformers actually pulling back a bit, and that and I should make this one final point. Something that we often forget, because when we are doing stock specific and we actually looking at, well, okay, if this is growing, prices will continue to rise. In a contractionary phase, and we've seen this in the 90s or any previous such period, at some point of time, the markets are not able to value even growth. So that's something that we forget. I've seen one of the most popular stocks that today or have known for the last couple of years, LIC Housing. You just have to tune back to 1995-96. Even if you spoke the LIC name, people would probably say don't touch that stock, it's government. So that's the kind of attitude there would be. Not only that, if you looked at its numbers, you would have seen that for the last 3 to 4 years they're growing CAGR 35% earnings. Okay, they're paying a 9% dividend yield. So why the heck are you not touching the stock? So that's how awkward a market can be. It can actually not be able to value earnings growth or dividend yields when there's a contraction in money, essentially because it's money that prices and reprices assets. Right now today we've been trying to allocate and reprice anything that has earnings. So but what I'm trying to say is that that's not a necessary case in a contractionary phase. When valuations start falling back, then even the best of ideas can see a valuation cut, and we got the first sign of that in the Jan-Feb sell-off. So we should be aware of that. So that's all in this update. I've given you an overall picture of what we are facing domestically and what we are facing around the world and the headwinds that you need to watch out for. Thank you.